Thank you so much, guys. Thank you so much for the invite, Pablo. It's a beautiful day, and actually, it's a wonderful venue, probably the best so far. Um, yeah, so for those that don't know me, I am Simo. I'm leading the growth for Aave protocol. Um, there are a lot of things going on. Today, we are going to speak about the next chapter in DeFi lending and what are the innovations that we are bringing with the new version of Aave v4. But before starting, I actually like to do a test. So how many of you are already using Aave? Can you raise your hands? Okay, okay, that's fine, you know. It's like you are more familiar than me with the protocol. Yeah. Nice. So, as Carlos was saying, yesterday was a big announcement date actually because we released our Aave app. So one of our mission is to make DeFi available to everyone, you know, to my grandparents, to my parents, and exactly what he was saying is our goals. You know, it's to simplify DeFi, abstracting everything. The app is very simple, you know, fintech experience. It's connected to 12,000 banks, so very quick, like, you know, one click in ramp with cash and deposit and get healed. Something like super easy, no DeFi infrastructure for the final users, but just, you know, the underlying. So for those that are not familiar with Aave, so Aave is the largest DeFi protocol and the largest lending market. So we are bigger than all the other lending markets combined. So we have 60 billion of net deposits, and we originated almost 1 trillion of loans. So we launched recently Horizon, that is actually is the real world assets market. So it's the largest and the fastest growing real world assets market on chain, where you can use real world assets such as like credit funds, T-bills, and so on as collateral to borrow stable coins such as USDC or other stables, and you can get leverage on top of that. So far, the main product, the core product that we have, it's called V3 because it's our third iteration. And V3 is V3 is the largest DeFi protocol, and reasons why it's so largest is because it became the main liquidity aggregator in the space. So for those that are not familiar, so Aave is a lending market where you can supply your assets, like crypto assets, and you can borrow assets. So when you supply, you get some yield. You can use these assets that you supplied as collateral. You can potentially borrow other assets that can be stable coins, Ethereum, Bitcoin, whatever. So, and you have only one pool that we call one market for each network. So Ethereum is having its own network, its own market, Avalanche is having its own market, and so on. So when you go in Aave, you have one option to deposit. You deposit USDC or USDT, Ethereum, or whatever. And it's very simple. And we have been able to attract a lot of liquidity. We are speaking about 12 billions of stable coins. And all this liquidity allowed us to have such a stable rates. And this is exactly what the institutions are asking for, you know, like stable rates and liquidity. Because let's say, for example, you know, an institution wants to deposit 500 million, so they can deposit 500 million in 10 seconds in one transaction. They can instantly get the yield that right now is around 4.5%. And if they want, they can potentially, you know, use these supplied assets as collateral to borrow other assets. And all these happen in a matter of seconds. Right now, we have almost 4 billion of assets, of stablecoin assets, only stablecoins that are available, you know, for people that want to potentially loop other strategies, take these stable coins to craft other positions that they want to take. And the main important reason why our growth has been so progressive over time is our attention to risk. So, as I said, we have one pool of collateral for each network, but to add an asset to this pool, we have to go through a very intense due diligence process that involves risk managers, service providers, DAO, on-chain voting, and all these kind of steps. And this allowed us to have a very safe collateral pool. This is actually the collaterals of the Aave markets across the different networks. And you can see that these are the most safe assets that you have in crypto. So Aave right now is backed by the safest assets in crypto. And this is one of the reasons why Aave, the USDC rate usually is used by many people and by many institutions as risk-free rate in the market. So this is a very big difference compared to other competitors, because some of them have some permissionless infrastructure where people can list assets that can potentially depeg over time. And this is something we think it's very important to have in V3, but it's gonna be the same pretty much in V3. So super attention to the risk. Battle tested, obviously, because we have been here since the beginning of DeFi. We saw so many black swans events, market crashes. During the last one, a few weeks ago, we processed around 300 million of liquidations in few seconds, no bad debt. So the Aave, and usually, smart contracts in crypto are judged by how much TVL they hold and for how long time. And Aave, in this sense, probably, we can say that is, the most resilient lending market in the entire industry. So the V3 is very successful product, but there is always something that we can do better. So we thought about the things that we can improve, and these are the main points that we are going to work on. So the first one is single risk profile class, because right now if you go in aave.com and you select a market, that could be Ethereum, Avalanche, or whatever, the thing that you can do if you have USDC is just deposit USDC in that market. So you have one collateral pool. This means one risk profile class. You don't have multiple rates available for the USDC. The other thing is that if there are two persons two potential borrowers with different collaterals. Let's say, for example, I have Ethereum and Mario has Uniswap governance token, and we want to both take out a loan of USDC. Right now in Aave V3, we are going to pay the same borrower rate for USDC, even though I am providing Ethereum as collateral and these providing Uni tokens. So this is something very important that we are going to address with V4, because we need to keep the protocol safe. And so this means that if you are taking more risk to the protocol, you are going to pay more interest rate than the others. The third one is the traditional chicken hack problem that we have in DeFi. So every lending market, every time we need to launch a new market in a new chain, it's very difficult because you need to bootstrap the initial liquidity. And this is a problem that all the lending markets have and all the networks have. And we will go through the V4 and how we can potentially solve this one, because solving this problem can enable an aggressive scaling of the protocol. Because right now scaling works because V3 did like a crazy growth over time, but we can do way better. And the capital can be used more efficiently in the sense that right now we have, users deposited around 12 billions of stables, but there are around 4.5 billions of stables that are idle in the protocol that can be potentially used to do something, right? To bootstrap something or to produce more yield to the LP. So this is the architecture of the V4. So it's gonna be based on two important concepts, that is the hub and the spoke. So the hub is a container of liquidity. So the hub defines the assets. The spoke is a logic that interact with the hub. And the user interact only with the spoke. So when I say a spoke is a logic that interacts with the hub, I mean that the spoke defines the collateral, how many of these assets are potentially be usable as collateral, which ones can be borrowed, and all the risk parameters and the LTV. To give you an example, let's imagine that the core liquidity hub have Ethereum, a wrapped Bitcoin version, USDC, and USDE. So a core spoke can potentially say, okay, users can use Ethereum and Bitcoin as collateral, and they can borrow only USDC. While this emote spoke, let's imagine, for example, here there is a Lido STETH. What you can do is saying, okay, in this spoke, you can have only Ethereum and Lido STETH, and people can use this spoke to do some LST looping or some strategies to leverage their staking position. So in this way, what we are going to achieve is that a better, let's say, risk management control, because the hub has all the control on the, let's call this credit line. So on the credit line that it gave to every spoke. So if we want to say, for example, that this is an Ethereum spoke, an emote spoke, we can say that the Aave core, the DAO governor, so let's say the governor of this hub can allocate to this spoke, let's say $10 million of Ethereum. So we can decide precisely what is the level of risk we want to take for each specific spoke. And this is a very important innovation. And the spoke can be different kind of logics. These are just few ideas, but there could be like many others. Like, you can have a spoke that is having the LP shares as collateral. There are a lot of DEXs like Uniswap, Balancer, depend obviously in the chain. You can potentially use these LP tokens as collateral to leverage your LP position. So if you are, for example, an LP that is providing USDC and USDT, as LP Uniswap, you can leverage your position because it's so correlated assets, and use LP token as collateral, borrow USDC, and continue to loop in that position. Otherwise, you can have an emote spoke. The emote is something that we already have in V3, so it's usually used by people that are using correlated assets, because the emote allow you to have a better risk parameterization. If you have, for example, let's say you use Lido STETH as collateral and you borrow ETH, so in that case you can use the emote version of Aave, and you will have a loan to value that is higher, that allow you to do, a better, an optimization actually of the looping strategy. Real world assets vault is another one. Right now we have Horizon, that is the real world asset market. In the future, you can have multiple spokes for real world assets, in the sense that you can have a shares vault you can have a share spoke, you can have a real estate spoke, you can have a bond spoke. So yeah, I mean, this approach is very modular in the sense that we can diversify a lot the spokes creation. The third one is something that actually we received a lot of requests about this, that is the fixed rate. So fixed rate is something that is missing in DeFi, and we are thinking about a spoke that enable fixed rate lending and borrowing. And the permission one is something that is very interesting for custodians, for institutions, because a lot of institutions, for example, want to keep their assets segregated. They don't want to pool their assets in other, like, for example, in Aave pools. So the permission spoke allows, for example, to custodians to keep their assets in their custody infrastructure, use those as collaterals, and borrow from Aave. So, and it's completely permissioned, and it's and we can potentially add a KYC layer on top of that. These allow people, institutions mostly, to have a segregated KYC environment, but still using the Aave infrastructure as underlying. This is the difference, you know. So graphically speaking, in V3 we have segregated market. For example, this is the Ethereum market. This is the Ethereum Horizon market. So, but both of them are completely separated market. In V4, what we are going to have one or more liquidity hubs that can provide to different spokes. And the spokes could be a standard spoke, a real world asset spoke, as we saw. But the important thing to understand is that the liquidity is going to be concentrated in one places and allocated, you know, to specific spokes according to specific guidelines that the hub governor will dictate. About the risk pricing, what is going to happen in V4 is exactly this one. That people that are going to have different collaterals will see a risk premium applied to their borrow APR. So right now, different collaterals pays the same borrow APR, let's say 10%, for example. In the future, you are going to deposit Ethereum. Okay, that is the base one. So no risk premiums. But if you deposit other assets, this is just an example, obviously, you will have some risk premiums applied. And so this means that we have our risk managers that are going to set risk premiums for a certain category of assets. So we will have different category of assets, each one with some risk premium. And based on the collateral that you provide, you are going to end up paying a final borrow rate that is made by the base plus the risk premium. This is made to keep the protocol safe. So more risk you bring to the protocols, more interest you pay. Less risk you bring, less interest you pay. And I'm proud to have these. This is the new design of the V4. So it's an example, but it's gonna be working in a similar way in the sense that you can have multiple hubs for each network. Each hub is having its own risk profile class, and you can have some hubs that are dedicated to some specific communities. Like, for example, we can imagine here an Ethena hub or a Maple hub. And why it is? This is because in this way we can create different kind of risk profile classes for different investors. And we will be able to attract more institutions, but also more investors that want to have, let's say, long tail exposure. So the prime hub, for example, in this slide is going to be the safer one. Let's say is only having like Ethereum or BTC as collateral. while the core hub can have Ethereum, BTC, Lido, EtherFi, some LST, very safe, and so on. And the frontier hub can have maybe some governance tokens into that. So when the user comes into Aave, he can decide, which risk he is fine to take. It's gonna be very easy. If we want to build like, a curation layer on top, it's super easy. But for now, we're speaking about this is the base infrastructure. So, and why V4 is gonna scale way better than V3 is that a core hub can potentially allocate a portion of the let's say a core hub is having 5 billion of idle assets, of idle stablecoins. The core hub can potentially allocate a portion of these stablecoins to a prime spoke or to Ethena-enabled spoke for a certain allocation. So we can, for example, be fine as a DAO to allocate 1% of the idle assets to the Ethena-enabled spoke. And with this architecture, where hub can provide liquidity to multiple spokes, we are solving and we are incentivizing a lot the innovation of the space. Because there are a lot of like potential projects that may have very creative ideas about how to do a specific lending market or what assets they have to do, they want to have it. And the main problem that all of them have is the liquidity. And in this way, what we can do is that we want to progressively open our infrastructure to everyone to use Aave as infrastructure. And if these projects, if these guys, if these like builders are going to build a spoke that makes sense in terms of like, track record or the assets that he wants to have, the core hub, that is where the most of the liquidity stays, can provide some liquidity to that specific spoke and can bootstrap that spoke. So this is the solution to the chicken egg problem I was telling you before. Because today, when you launch a new market or you launch a new lending market, the bootstrap of the liquidity is solved in two ways. Or you rent the TVL, and so you do a deals with funds and you pay a certain amount to get the TVL into the protocol, or you provide incentives. These are the two ways. This is a third way where you are not like spending money from your treasury. You are not like dumping your tokens into the markets, but you are getting a credit line from a core hub. And the core hub is incentivized to do that because the credit line obviously will have an interest rate, plus there will be a potential risk premium that depends on the level of the collaterals that are in the spoke. If the spoke is going to be very safe, probably there is not going to be any risk premium. But if the spoke is going to be a riskier one, there will be definitely a risk premium. So yeah, thank you so much for the attention. I don't know where we are in time, so if we want to do maybe some 3-4 questions, I'm fine to do that. Please.
Yeah, thank you for great speech. I actually have a question about your stablecoin Go, and what are your plans with expanding Go TVL supply and like set of features?
So Go is one of the most important projects in Aave, and yeah, we're very bullish actually on Go. We are going to increase the liquidity of Go over time. This is the main issue that all the stablecoin has, the liquidity in the secondary market. And Go, we are confident that Go can be one of the main revenue driver for Aave in the future, and can allow to have a lot of freedom actually in what we can achieve in terms of spokes also, because we can imagine a spoke where we have only Go as a stable coin, and the DAO can take, and in that case, obviously, it's the DAO that is taking the risk because there are no like suppliers. So let's say, for example, there is a spoke where we don't want to have USDC or USDT because the DAO is not fine to have it, but the DAO maybe could be fine to have some Go. And if we have some Go in that spoke, it's actually a risk for the DAO, but all the interest rates, obviously, for the Go borrowing are going to be part of the treasury, and so it's a very interesting element that we have for the V4. Yeah. Yes, please.
Yeah, great presentation. I was just wondering about this premium that some people with riskier assets will pay, and how is that premium going to be distributed? Is it going to be distributed to people who put collateral, or is it going to the DAO or something else?
Yeah, it's gonna be distributed, you know, into the pool. So it depends, because you have these premiums. Let me show you this slide actually. So here we go. So the liquidity hub can allocate credit lines, and based on the collaterals of the spokes, so the spoke has to repay the credit line. So if the spoke has only ETH inside, the credit line is just, the rate that is going to pay is defined by the interest rate curve that is defined in the hub. Because the hub, the hub, that is the container of liquidity, define two things. Define the list of the assets, and define the interest rate curve for each asset. And so if the spoke is only having ETH, for example, as collateral, that's fine. You know, it's paying only the interest rate that is defined by the core hub. But if the core spoke is having multiple collaterals, we are going to have, you know, a weighted parameterization based on the risk of the collaterals, and all the risk premiums are going to be in the liquidity hub for the LP of the liquidity hub. Yeah. Okay. Thank you so much, guys. Thank you, Pablo.